Hello everyone, this will be the video lecture for class 13 in which we'll be looking at choice of entity and what to do when we're trying to figure out if we want to form either a sole proprietorship, a partnership, an LLC, or a corporation. So we'll start by looking at the last category of business entity, which is an S corporation. It's similar to a regular C corporation, which we went over yesterday, but an S corporation is simply different in legal form and process and gives some protections if elected to be filed that way with every state government. So we'll look at what S corporations are, how to be eligible to transition a C corporation into an S corporation. Then we'll look at something called election, which is something that needs to be done. It's a process within registering an S corporation. Then we'll see how an S corporation status can be terminated. Once we've covered that, we will then take a look at the advantages and disadvantages between a C corporation and an S corporation. Then we'll summarize all the different types of corporate entities. Then we'll summarize all the different types of non-corporate entities like partnerships and sole proprietorships. Then lastly, we'll look at the differences between all of the business entities, both corporate and non-corporate, and then we'll go into the pros and cons. So this will be less of a substance-heavy video and more so a general knowledge, macro look at how to choose an entity. So what is an S corporation? Well, the benefits of having an S corporation is that the S corporation is not subject to federal tax, or specifically federal income tax. So this means that when the S corporation receives income, losses, deductions, or credits, then that type of tax calculation is passed through to its shareholders, much in the same way a partnership works, where it passes through to the owners, where it's not a separate legal entity like a C corporation or a limited liability partnership, right? So what this means is the rate and the way that the pass-through items are calculated is each shareholder's per day and per share basis. So each shareholder is taxed on his or her share of the S corporation's income as it is earned. Then the distributions of cash or property are not calculated as income when doing this calculation. So a corporation is treated as an S corporation only for those days in which a specific eligibility requirement is met and the required election is effective. In other words, S corporations have a separate tax basis within the federal government, and the taxes are passed through to the people that own the S corporations, specifically the shareholders. Those taxes are calculated based upon the share that's owned by each shareholder and is taxed individually to each shareholder. And the government will only treat this federal tax exemption when a specific eligibility requirement is met and the shareholder does something which is what we call a required election. Then they will get the tax benefit. So what is eligibility? So eligibility can vary, and it depends on the corporation, its shareholders, and the structure of its stock. But there are specific rules. So there can only be one class of stock to be viewed as an S corporation by the federal government. So variation in the voting rights within that one stock is allowed, but the rights to the profits and assets when liquidated must be identical, And debt may be treated as a second class of stock. So this is important. Excessive debt may classify as more than one class of stock, therefore invalidating the eligibility requirement. So moving on, the number of shareholders may not exceed $100. 100 shareholders. So each shareholder can only be an individual, an estate, or a qualified trust. Non-resident aliens may not own shares in an S corporation. The reason why is because the S corporation must be domestic and eligible in order to get this tax benefit. So there's also certain groups of business entities that, depending on the purpose in which they're formed, cannot elect S status. So these would be insurance companies, possession companies, domestic international sales corporations, and former domestic international sales corporations. So this is why so out of these, there's a reason why S status cannot be allowed. It depends on the industries that they're in, which makes it so that the tax exemption on a governmental rationale basis is not allowed. So that would be eligibility, the first prong. Second, you have election. So election simply refers to if a corporation which otherwise fulfills all of the eligibility requirements to give it S status, if they are fulfilled those eligibility points, then that corporation makes an election for S corporation status and they file Form 2553. So all shareholders at the time that the form is filed must also file a consent to elect for S corporation status, which means each person who was a shareholder at any time during the part of the tax year before the election is made must also consent. If there are any former shareholders that may have owned a share and now the corporation's going for S status and they don't consent, then the election is considered made for the following year. So it's a very, very stringent rule for this tax exemption. So when does an S corporation status as an S corporation terminate? Well, it's upon the occurrence of a terminating event. And when that happens, an S corporation becomes a C corporation. So there's three instances in which this could occur. The first is if a majority of the shareholders, both voting and non-voting, consent to an effective revocation. They choose not to be an S corp anymore. Another is if there's an eligibility requirement that's not being satisfied on any particular day. And if you recall, the eligibility requirements require no more than 100 shareholders and that there must be only one class of stock. So if that ever changes, then an S corporation is terminated. Lastly, there's something called the passive investment income termination, or PII. This is when the passive income generated from investments that an S or C corporation makes, if over 3 consecutive tax years, the subchapter C and accumulated earnings and profits on the last day plus the PII, which is the passive investment income, exceeds 25% of gross receipts or gross income. And this could be business income, or it could be asset income, that type of thing. So that's what an S corporation is. And in the next video, we'll be going over some advantages and disadvantages of corporations.